So we looked at if they give you income, what to do. And in the T, if they give you income, we said multiply, didn't we? Well, the T-bar is either multiply or divide. What if the question says, how much income do they need? So if they're looking for income, do you think they're looking for up here or down here? Down here, right? So if they're looking for income, you'll have numbers to go up here, and you'll be looking for that. So if the question says, how much income do they need to cover these payments? You're going to divide. Okay? So it's just the opposite. They didn't give you income, they're looking. So look with me at 30. I'm on page 459. Look at number 30 and see if you can back into that one. Number 30, the question is how much income? Now one thing let me give you one hint. If they're looking for income, you're not going to use both factors, because if they're looking for income, think about this for a minute, and they've got debt, you're going to add everything up to see how much income needs to cover it, right? If they've got debt, isn't the housing in this number already? So if they've got debt and they're asking how much income, you'll divide by 36%. If they don't have debt and they're asking for how much income, you would only use the 28%. So when you're looking for income, you'll use one or the other, not both. That makes sense? Because 36%'s got housing in it already. All right, take a few minutes and see if you can figure that out. And if you finish it quickly, do number 34 because it's similar. 30 and 34. Bless you. How you guys doing on those? Do you see how it works? It's just the opposite? Who's still working? Okay, take another minute or two. Who's got number 30? Who's done number 30? Yeah, Dara's coming to do it. Kim, you can do the next one. Okay. What answer did you get first?
Oh, I got D. Is it D?
No.
It's not D.
Not D.
For 30?
For 30. Who's got this?
You got it?
Who's got C? Somebody else come up here.
Oh.
I'm sorry, honey. We're gonna put you back in your seat. We'll get somebody else to come do
Good
it.
thing you told me before I put it up there.
Well, we're not trying to embarrass, but
So what I do is I just have all the possible answers and then work with those numbers, so I don't necessarily
you don't do the math?
well, I do the math, but I just use the answer choices to find out which one
That's the way I told you not to do it.
is faster.
Oh, you mean just looking at it
Well,
or calculating it?
calculating.
So you're doing every answer until you get the answer. Look at him, I don't mean to embarrass you.
No.
Well, you know what, I'm not gonna, you guys do it the way you want to.
Yeah.
And you said it was faster to you?
Yeah, that's what I did in the
Okay.
previous test.
Okay, if it's faster to you. But that's not the way we are.
But
Had to get my
Did it
dick,
that way.
okay, let's look,
I just added the, what their monthly payment could be, what their debt was, added that together, multiplied that by 12
Oh, I see.
for the yearly.
not multiplied by 36.
or divide, sorry.
Divide.
I divided.
Okay, I thought you were doing algebra. Lord.
And then divide by 36%.
Okay. Does everybody see that?
Yeah.
So she added the 2 and multiplied by 12 because it asks for yearly. Now you can multiply by 12 at the end, but they're asking for annuals. Everybody see it? So in other words, if we put it in the T, Lydia, did you find your mistake?
Yeah, I did, I chose the answer for the .28 instead of the .36.
There, uh-huh.
Yeah,
And so since there's debt,
because I just saw 68.229 there, and I didn't even think to do the second.
Mhm. Okay, so you add that up and you get 1592. And because of this, divide by 36. So they're gonna let them have, okay, I'm gonna stop talking right now for a minute. So what is the answer? 53?
0, 6, 7.
Everybody see that?
I might be a little lost, but how did you know it was for 36?
Because they gave us debt. If they give you debt, that's the clue that you use 36.
Because that's what they're asking for, right?
They're asking for total income, but don't you have to have enough to cover the debt too? Right? So when they say 36%, that's your go-to on, that just says debt, use debt factor. That makes sense? All right, anybody do 34? Anybody get there? Amber, you wanna come do it? That'd be cool. I appreciate it. Well, first, what did you get? C. Okay. C is it. Job. Good job. And let's give Kim, this is for Kim too. All right, everybody good?
Yeah.
So if you had one of those on your final exam or at the state level, you're either going to multiply or divide. If you're looking for a bigger number, we know in the T-bar you divide anyway, don't you? And the one thing I think that maybe is what people are forgetting or maybe you don't understand it quite yet, if you've got debt, you just know you got to really pay attention to the debt ratio. Whether you're multiplying or dividing, you got to look at the debt ratio. Everybody good? All right, let's talk about a few more things before we call it a morning, because I want to give you out your homework for the week. And I mentioned to you that Chris will be here Wednesday, right?
Yeah.
And so be prepared for Unit 21. I think that you'll like Chris. He's young and energetic, and he's knowledgeable. Go back with me to the beginning of Unit 15, and we'll see where we get to. We're not going to spend a lot of time here. It's level 1, but I want you to make sure you understand the difference in the primary market and the secondary market. What is the difference? What is the difference in the primary market and the secondary market? Who goes where? Where would you go shopping if you wanted a loan? Primary market. So think about where you do your shopping would be at the store that's local, even though your loan doesn't have to be local, but you go shopping at the primary market. Where does the primary market go shopping? Secondary market. So when they're shopping, what do you think I mean by that? The secondary market is where the primary market would go to peddle their wares, if you will, but aren't they also looking for money? Why are they looking for money?
So they can lend more money.
So they can bring it back and lend more money. So when we talked about bundling loans, the lender is packaging. You know, this is an asset, isn't it? These loans are all assets. They're accounts receivable, aren't they? Is that what you call them, or payable? It's money coming into them. It's an asset that they're going to go sell. And so they bundle, hopefully, loans that are similar. What happened in the financial crisis, though, was that a few bad apples got into the packaging. You know, some of those subprime loans. And when those bad apples got in, it kind of started crashing some things because the packages became overvalued. Because when the market goes, when the primary market packages and they take to the secondary market comes and buys, the secondary market might repackage them into, what do they call them, securities, and then that's when they are bought. Wall Street came in, and anybody can come in, and investors, big time investors, and buy those products and then take them and sell them again. So it's like recirculating money. So the primary market bundles their lots of loans, takes them to the secondary, and the secondary market maybe repackages them to go sell so they can get money so they can come back and buy more. So it's everybody, you know what the way I look at it is, everybody, they're all making money, aren't they? Because it's kind of like you're buying at wholesale, selling at retail in a way. So the primary market, where you and I would go, look with me if you will on page 428 and 429. Most of us go to commercial banks, probably, wouldn't you think? One way or the other, online even. Some folks go to credit unions. We can borrow against our insurance. We can borrow against our 401k. But when they talk about these pension funds and the endowment funds, when they talk about entities like that, those companies, when they're accumulating premiums, for example, when you pay your insurance premium, all those premiums are sitting there, and the insurance companies want to invest that money, don't they? And so they might invest in real estate projects, funding development, and that sort of thing. You're not going to go and borrow exactly from a pension fund. You know, that's where they would lend in big development, maybe commercial projects. I would remember and pay attention to mortgage banking companies versus mortgage brokers, and I'd like you to tell me what's the difference in that. Mortgage bankers and mortgage brokers. The bankers make the loans, and the brokers do the transaction. So a mortgage broker may have access to different types of loans, different lending places, and maybe they would go searching for you a loan. Do they expect to be paid? And I wonder who's going to pay them. Huh?
Our clients.
The clients do. How so? It's going to be, the lender's going to pay it literally, I guess. But, well, the lender's going to pay it, but the consumer's paying it by paying a higher interest rate on the loan or something like that. Go back with me, if you will, and let's talk about the Federal Reserve for a minute. What is the Federal Reserve? And what's their function? Huh? What interest rate? The Federal Reserve is like an umbrella, And the primary market and the secondary market are under this umbrella. And Renee said they set the interest rate. What rate?
Well, don't they set the rate of how much people can, like, how much the banks under them can give out, and that in turn,
Not how much they can give
how
out.
much they can loan, sorry. I don't know. They weren't explaining it poorly, like, they decide how much is sort of can be circulated.
Well, they decide how much can be circulated in the marketplace by regulating bank reserves. Did y'all read that? In other words, when we talk about the rates they set, Renee's not completely off track, but just a tiny bit. The rates that they're setting would be called the discount rate. And that's what they charge member banks to borrow money from the Fed, from that bank, from the Federal Reserve. So they charge member banks, if member banks need to borrow money, they charge them what we call the discount rate. The discount rate now is it between 2.5. I mean, if they always put it in a range. The discount rate, this is where you hear the politicians talking about it, everybody. This is when Donald Trump, the last time the Federal Reserve was going to meet, or the chairman was talking about raising the rate again. Donald Trump said, if you raise it, the economy's going to slow down. And why do you want to mess with that? Because our economy is so good right now. And that's what you were talking about. When they raise that rate, it slows down things, because when they raise the discount rate that a bank would borrow and pay them, then the bank charges more at our level to lend us money. So indirectly, Renee was exactly right. The discount rate is what they charge their member banks to lend money or to borrow money, and then the banks come back with that money and they're going to lend it out to us, and they're going to charge us a little more because they got to pay that back, right? And so it affects what the market's going to do that way. Ian brought up about the slowing the market down. That has to do with the bank reserve requirements. If the Fed says, don't lend, keep this amount of money in reserve. In other words, for a rainy day maybe. I'm just kind of making that up. But don't lend this money. Don't use this money. If the Fed says for them to have a higher reserve that they're not lending out, well, that's going to slow down things a little bit too, isn't it? They're not going to be lending as much because they got to keep some saved up. When the Fed says lowers the reserve that the banks have to keep, if they lower it, then lenders lend more money, and that generates the economy. Way back in the 70s and 80s, I think this was in the 80s, if the in the 80s out in Texas anyways, where I remember hearing this, the reserve was so low, almost nothing. And there were savings and loans out in Texas that lent all their money, almost all of it. It's kind of like spending all your savings. Then when the market started, when there became a recession, and we go through recessions, and some of the loans that they had made, the people began to default. And so if they're defaulting, the lender's not getting back the money that they lent from payments, aren't they? And then if there's a deficiency, a default and deficiency, the lender's not being able to recoup their monies that they can go lend to someone else. And a lot of those banks went out of business during the 80s. It was a bad time then. So the Federal Reserve kind of keeps a lookout on what are the rates, what are the reserves, because they kind of want to keep a handle on the market, and they're trying to prevent inflation, where your dollar's not worth as much. Go with me over to page 429. And the secondary market, we said they buy these loans from the primary market, not one loan at a time, a package of loans. They rebundle them and go sell them to the open market. And so the biggest players are Fannie Mae and Freddie Mac, aren't they? Now Fannie Mae, if you're ever asked, is the largest and the oldest one. And what did they come into the marketplace to do way back when? Was it in the 40s? But way back when, what did they come in the market to do? It's a secondary warehouse, so they're buying loans from the primary. The kinds of loans that they were interested in were the maybe we could say the safer loans like FHA. You know, they were looking for the backed loans and, you know, not so risky. So when they first came into the market, they were looking to buy FHA loans. Over time, they got into VA loan purchases, and then over time, even conventional. Freddie Mac is a competitor, you could argue. They came in with the idea of wanting to buy conventional loan products. Conventional loan products are the safest because most people put down more payment, don't they? Both of those entities, Fannie Mae and Freddie Mac, and by the way, I would look at the real names of those entities. Fannie Mae is called the Federal, where is it? National Association, where is it? Federal, okay. And Freddie Mac is called the Federal Home Loan Mortgage Corporation, isn't it? So Freddie Mac and Fannie Mae are now under government control. In other words, during the financial crisis, the government had to bail them out. And I don't know what you think about bailouts, but that was probably a pretty good one. Because if there's not that secondary entity to kind of, where monies can be recirculated so the primary can keep lending, no telling what kind of a mess we would have been through. Now, when we talk about this financial crisis recently, y'all remember it, don't you? What do you remember? Because we've been through it. It's not like a way history lesson, because most of us went through it.
It was harder to get loans.
It was harder to get loans? How do you mean? Why was it harder to get loans?
Well, I don't think they had to be very careful about what some of the mistakes were in the past.
Mm-hmm.
So that's why they were very cautious of giving loans, making sure you qualify, having your credit score, just, I guess, tighter. It was like a tighter.
It was like tighter times. It's like it was real loose, and then in the crisis, and now it got real tight. I can remember an agent saying to me one day, my buyer client went to the bank, he's got an 800 credit score, and he's having a hard time getting a loan. And before, they were giving loans to the 525 credit scores. It was real loose. And then they kind of got burnt, if you will, and now they're so cautious. So even though you may not have defaulted on a loan, even though, you know, it might not have been affected you personally like that, this financial crisis affected all of us indirectly, didn't it? Like it was harder to get loans.
And they wanted more down payment. I mean, one of those ratios to.
Mm-hmm. They wanted more down payment, and so they got tight. They've kind of moved back now. I think they've gotten a little, probably a lot looser than what it did go to. But that happened, and it affected people lost jobs. I mean, the whole economy was being affected. And it wasn't just the lenders, even though a lot of people want to blame the lenders for that meltdown. It was a perfect storm, really. People got these adjustable rate loans, qualified on 2 incomes, then somebody loses their job, and now one person trying to make a payment that took 2 people to qualify for. It was really a mess. Affected the real estate industry. Some real estate people couldn't hang on and got out of the business. Some real estate people had to adapt and say, how am I going to do my business now? Real estate agents started doing broker price opinions from lenders, where lenders would call them and say, will you let us know what you think this property's worth, and we'll pay you $100 or whatever they were paying, instead of calling an appraiser. And an appraiser may charge $400. They were calling real estate brokers, and I'll tell you all about that another time. But the real estate commission and the appraisal board got into some discussion over that, where the appraisal board said, your brokers are acting like appraisers, and they don't have a license. So anyways, guys, we'll pick up the rest of this unit when I come back Thursday. I want you, Chris is not going to pick it up. I will, though, okay? So we'll talk about truth in lending and that sort of thing. Chris may mention some of that, but I'll make sure we pick it up Thursday and review it. And so be prepared for Unit 21, because that's where he's going to start his discussion.